also chart patterns that we're looking at today, right? So I just going to give it a couple of minutes while I test it. Make sure that the audio is working, the video is working, the stream is working, right? Just give it a couple of seconds, make sure it works. I need to check on let me check on a few things, make sure it's all working. Okay, cool, it's all working. It's all working, no problem.
The chart, I go here, right?
Chart will be here, yes.
And you have a live
yeah,
chat
correct.
you requested, right?
Yes. Okay. All right. Okay, I just want to make sure everything is working. Anyway, all right, let's start properly now, right? Guys, thanks for tuning in for today's session, right? Like I said, today's session focuses more on the educational nature of it. So yesterday's session was on the market outlook for the week ahead. And today's session focuses more on the educational topics, the things that you can learn to apply in your trading. More specifically, today focuses on chart patterns. All right, so we have heard a lot about chart patterns. We have the head and shoulders, we got the double top, double bottoms, we got all channels, wedges, we got all these different kind of chart patterns, right? But they can actually be broadly kind of categorized into two kinds of patterns. One is continuation, right, and one is reversals, right? So there are some chart patterns that can predict reversals very well, like double top, double bottoms. There are some chart patterns that actually predict continuations very well, and that is, for example, the wedges, channel breakouts, right, flags. Those predict continuations quite well. There's a difference between each of them, right? But in today's session, we're going to focus more on reversals, right? We're going to focus a little bit more on reversals in a bit. All right. So anyway, this webinar is brought to you by Everest Fortune Group in collaboration with Vantage Markets. Right. So we are an award-winning research firm and finalists for 2019, 2020, and 2021 for best FX and best equity research. We work with a lot of the major financial institutions to help them forecast where the markets are heading. And now we have a special partnerships with Vantage Markets, where I bring you guys the good stuff, the juicy stuff, the stuff that you learn that can really help you take your trading to the next level. Okay. Now let's move on to the next topic over here, right? So disclaimer. This will be this is a team here, Everest Fortune Group, right? That's me, I'm the chief trader, right? Chief trader. We got Cassandra, also known as Bob, and some of you guys who have seen her quite a number of times, right? She's actually down with COVID now, so wish her well, as she's recovering. And now, of course, we have a new analyst today, called Vico, right? I think you've seen her in yesterday's session, right? So it's still her second and third webinar. She's still kind of getting used to presenting, so go easy on her later, okay? But yeah, so we'll be the people who will take you through today's webinar. Now, all right, so what I want to encourage you guys is that we have another screen that's literally open over here, right? Just to help us monitor the kind of questions that come through. What I want to encourage is that if you have questions on any of the maybe any of the charts, if you're not familiar, right, please send them through. We'll do our best to answer them on the go, right? And if you have actually requests for us to look at certain currency pairs, certain instruments, right? If you spotted certain chart patterns on any of these instruments, send them in the comment section. We'll take a look at them together, okay? Now, as usual, I need to touch a little bit quickly on the disclaimer, right? Where you are on the disclaimer, right? Just take note that this webinar is purely educational and in nature, and nothing in this webinar should be construed as investment or trading advice. So guys, please do your own little due diligence before trading, all right? Now, let's see. Let me go on to the next thing, the agenda for today. All right, so like I shared earlier, be touching on three main things. This is the first of a two-part series, right? And as I shared, there are two kinds of chart patterns that you tend to notice, right? There are the continuation patterns, and then there are the reversal patterns, right? So chart patterns, if you think about it, they're actually a lot of it revolves around psychology, right? The reason why you see, for example, let me just pull up a pen over here. The reason, like if you see a double top pattern, over here, okay, right? So the psychology of this is that the bulls were actually trying to push prices all the way up. It failed to, and then the bears push it down. The bulls try to push it up again, and then the bears push it down again, right? And at this, what we call an inflection point, right? The bulls finally lost to the bears, triggering a bearish move. So at the core of it, right? Sometimes we tend to be too caught up in the concept of chart patterns, right? You look at all the different like head and shoulders, double top, cup and handle, all these kind of chart patterns. But at the core of it, it's actually just the psychology of the market playing itself out, right? It's just the psychology of the market playing itself out. The bulls versus the bears, right? Where is the battleground? For example, a double top, which Vico will be touching on later. The battleground is over here, right? Whoever wins the battleground takes over, right? The bulls wanted it to go up, so it very well could have went up, and this could have been something like an expanding wedge, right? And prices could have went up, right? Or if they lose, it can become a double top and it goes down. So it's just at its core, at its essence, just very much to do. Oh shit! It's very much to do with just the psychology of the markets. All right. So what I want to encourage you guys to do is, as you are looking at, as you're going through the webinar, as you're going through the webinar later, right? Think about it as that these chart patterns are actually kind of it's just kind of mapping out the psychology of traders, right? So, for example, a double top pattern in this case will only be effective, right, if the tops occurred at roughly the same level, right? A double top would be ineffective if the first top was like that, and then the second top was like that, right? So this will not be a strong double top, even though it technically looks like a double top, but because of price being so high over here and price being low over here, right? There is it's much weaker, right? It's much weaker, right? So and the psychology of this is because actually the bulls were able to push prices up so high, and then the bears push it down, right? So when we are explaining the concepts behind the double top, the double bottom, all the different kind of chart patterns later, one thing to take note of is that try to break it down a little bit further and see it for what it really is. All right. Now, I'll be passing the time on to Vico. All right, I'll be passing the time on to Vico. Go easy on her. It's only her third time doing webinar, so she knows her stuff, right? Just that when it comes to presenting webinars and trying to look at the explain it and look at the charts at the same time, it can be quite tricky even for me, right? So have fun, right? Have fun in this session. Right, I'll pass on the time to her as she touches on the next topic on the double top pattern. Okay, Vico, over to you.
Thank you, Desmond. Hi guys, I'm Vico. So today I'll be touching on the chart patterns. So right now we'll be touching on a double top. So what is a double top? So a double top is an extremely bearish technical reversal pattern that forms after an asset reaches a high price 2 consecutive times with a moderate decline between the two highs. The two highs will be here. This is the first peak, first high, and this is the second peak, the second high. It's not easy to spot, as one would think that, because there needs to be a confirmation with a break below support. The support area will be around here, the net line level. So which means that you have to wait for the confirmation of the asset's price to fall below a support level, which equivalents to the low between the two parallel highs, which is here. So to identify a double top, you need to ensure that this level and this level, the peak of the first high and the second peak of the second high should be the same level, even if it's not 100% the same, but should be close to 80 to 90% the same, right? And this will be the support level, that it should be equal to the low between the two prior highs. So what is the difference between a valid and invalid double top? So a real double top is an extremely bearish technical pattern that can lead to an extremely sharp decline in a stock or asset. Okay, let me show you. Okay, for how do you identify a valid double top? So this will be a valid double top. They have like the same highs. This is the first peak and this second peak, and this will be their support level, which we can also call it as a net line. As you can see, like another way to identify a double top is you can see that it's a M shape, right? It's an M shape. So the distance from here, the bottom to the top, the resistance level, this is the bottom, we can also call it support level or the resistance level over here, the high. They have to be, this distance have to be the same or almost the same as this distance over here, to make sure that it's a valid double top. So however, it's also important to be patient and identify the critical support level to confirm a double top identity. So like normal case, I know there's a lot of support level, probably the price goes down here, but you have to be patient and wait to identify the most important, the critical support level, so that you can confirm the double top identity. Some people, like, based on double top solely on the formation of 2 consecutive peak, could also lead to some like false reading and hence cause an early exit from a position that can not really lost you, like, you know, you will be less profited from what you should be getting, right? Let's look at some examples of double top. From this chart, we can identify that the highest point would be here. The first highest point, and the second highest point of the double top will be here. And this will be the resistance level for the double top. And where do you identify the support level, right? So after from the top, and the price goes all the way down to this area, this bottom support level that you identify, and then from this support level it bounces off to this area over here, the resistance level here. And from here you can identify that this is a double top. You can see the shape M over here. So the distance from here, from the bottom here to the top here, is almost the same as the distance. You can tell that it's almost the same distance from here to here. And of course, the first thing that you need to identify for this double top distance would be here, the bottom here to this top here. And for the second high, for the second double peak, will be from this top to this bottom here. So they have the same distance, and here the same distance, so you can identify this is a valid one, right? Oh, let's take a look at the one that is invalid, or maybe it's like very not so significant. So for example, if I take this is the first, or maybe identify this is the first peak and this is the second peak. This is not a valid one, and also is not very significant because the shape and the distance is like that. This is the second peak is higher than the first peak, which shouldn't be taken as consideration for a valid double top. Or if you come across this shape of double top, the first peak is also higher than the second peak, this is also not considered a valid one. So this is not valid and this is not valid. The valid one should be this, the same height or almost the same height. Let's look at another example. So you can see that the prior trend here is the ascending up here. So from the bottom, and it goes all the way up to this highest point top for this first peak. And when it reaches the resistance level, it goes back down to this level. It bounces off, right? It bounces off from here to the top, and it goes down here again. As you can see, once it reach this level, this supporting level, it's trying to break this net line. So once it break this net line, once this is break through, the price is a confirmation for the price to go on a bearish continuation to here. So the confirmation for a bearish dip or bearish continuation would be at this area. So you just have to wait for confirmation before you get into your trade for a short. Okay, next for double bottom. So what is a double bottom? Double bottom is the opposite of double top. But the shape of a double bottom would be a W. You can see as a W. It's a shape of W. So this is double bottom is a technical analysis charting pattern that describes a change in trend and also a moment reversal from prior leading price action. It's also described the drop of a stock or index or like other financial instruments for a rebound and now drop to the same or similar level as the original drop. So this level here, just like I say, the distance from here to here must be the same distance from here to here. The double bottom also look like the letter W as I mentioned earlier. The twice touch low is considered a support level. So the support level will always be here for the double bottom. And the net line over here for double bottom will be their resistance level. So we will be identifying this area as the first bottom where it touches this support level here will be the first bottom, and the second touch on this support level will be the second bottom. The advance of the first bottom should be a drop of 10% to 20%. Then the second bottom should form within 3 to 4% of the previous low, and volume on the ensuing advance should increase. Hence, the double bottom always follows a major or minor downtrend in a particular security and signals the reversal and the beginning of a potential uptrend. So as you can see on this valid double bottom, once the price from here goes all the way down or drop all the way down to this support level, it tends to bounce off, touches this resistance level and goes to another drop again to this support level and bounce off again to resistance level. And once it break through this net line, which is the resistance level, it's going to be bullish. It's going to be on a bullish run. It's going to shoot up. So if you want to trade and you want to go into trade when you see this pattern, you just wait for confirmation around this area. Wait for it to break this net line level. And once it breaks, then you go for a long position to ensure that you're going to be profiting. So what is the difference between a valid? How do you identify a valid and invalid double bottom? So a valid double bottom would be showing like this, right? This is a support level. It will be the same. It will be the same height or same low. The first bottom and the second bottom will be the same low here. And they will have same levels of net line, which is the resistance level over here. They will be the same here. That consider a valid double bottom. What if double bottom appears to be like in this manner? Okay. Or it appears to be in this manner. So either this manner or this is not a valid. Why is not valid? The first bottom of this is higher than the second bottom, which is not valid because they are not on the same level. And same goes for this type of double bottom. This is high, this is lower. The first bottom is lower than the second bottom, the second low over here, which is not valid. So this is not valid and this is not valid. The valid one would be this, which is same level, same height, and same distance from here to here. So it is also essential to be patient and identify the critical resistance level, which I mentioned earlier. The critical resistance level would be around this area to confirm a double bottom's identity. So always look out for a extremely bullish pattern for a double bottom to ensure that you're going into your trade in the right time. What does a double bottom also tell you? The longer the duration between the two lows in the pattern, the greater the probability that the chart pattern will be successful. So at least give a 3 months duration is considered appropriate for the lows of the double bottom pattern. So in order for the pattern to yield a greater probability of success, therefore, it is advised to use daily or weekly data price charts when analyzing markets for these particular patterns. So to allow double bottom to form in this shape, it takes time. So give it put it in a way that for 3 months time you can do it in a daily chart or weekly chart, so that it gives you a clear picture of this double bottom shape. They give you more accurate information. So although the pattern may appear on intraday price chart, but it is very difficult to ascertain the validity of the double bottom patterns when intraday data price charts are used. And the double bottom patterns are always follow a major or a minor downtrend in a particular security. So hence signals the reversal and the beginning of a potential uptrend. So once it breaks, so you know that one is going up from here, one is coming down here and going up from here, and you are unsure that if it is going to be bullish or is going to have a reversal to be a bearish, you wait for the resistance level over here, which could tell you like more like higher probability that if it will going further to a bullish momentum or the bearish momentum. So wait for here, and once it breaks, it will be bullish run for a potential uptrend. Let's look at some examples of double bottom. As you can see that I mentioned earlier previously that if you see that this shape, the W shape, is a valid one. The distance, as you can see, the distance from this area to this area, and the distance from this area to this area is the same distance. So it meets the first factors, one of the factors, that the same distance of the length over here and here for the first bottoms, first low, and the second bottom, second low is the same distance, so it meets the first criteria. So once price from the top goes all the way down here, it bounces off to this critical, we call it the critical resistance level, which is net line. So once it reaches here, it reverses down to this bottom support level. For once it reaches the support level, it bounces off again to this. So what happened after that is either it breaks through to go bullish. If it doesn't break through, as if you wait for confirmation, it doesn't break through, it's going to be bearish. So you can wait to see if you can go for a long or short at this area, at this level. So what does this mean when it stops at this area? It could mean that the volume and buying pressure are accelerated. Means that there are more people are buying more, that cause the volume to be going upwards. Next, let's look at the second example. So the price target is always here, which is the resistance level. So this price target could also say that it's going to be the same. The price target over here, A, is going to be the same distance or almost the same distance as this price target B. So once it reaches here and breaks through, you can predict there's a high chances that the price would goes up to the same distance as this distance at the B area here. So this, in summary, the double top look like the M shape over here, and the double bottom will be the W shape. For double top, the difference is it has to reach the resistance level before it reverse down and before it breaks through the support level here to go for a bearish run. So the confirmation would always be around the support level for double top. Whereas for double bottom, the confirmation will always be at the resistance level here, whether you want to go for a long for bullish run or a short for a bearish run over here, right? Next, we will be looking at head and shoulders. So what is a head and shoulders pattern? A head and shoulders pattern is a chart formation that appears as a baseline with three peaks, where the outside two are close in height and the middle is the highest. So let me show you here. So it's going to be looking like this for a head and shoulder, which means that the head and the shoulder has the same resistance level. Here. And the middle, which is the middle point here, will be the highest level as compared to the shoulders. So in technical analysis, a head and shoulders basically describes a specific chart formation that predicts a bullish to a bearish trend reversal. The head and shoulder patterns is also believed to be one of the most reliable trend reversal patterns, and also it is one of several top patterns that signal with varying degrees of accuracies that an upward trend is nearing its end. The head and shoulders pattern forms when stock prices or like some derivative prices rises to a peak and subsequently declines back to the base of the prior up move. Then the price rises above the former peak to form the nose, and then again declines back to the original base. So finally, the stock price rises again, but to the level of the first initial peak of the formation before decline back down to the base or neckline of chart patterns, one or more. So how does the movement here? So it will go from, normally for this head and shoulder, it will move in the direction of going up through here to the resistance, to the small resistance level, and then retreats back to the support level. And then it bounces off all the way up to this top, the highest resistance level. And then from the highest resistance level, it goes all the way down to the support level over here. And it's going to be bounced off again to this small resistance level, which is the same as the previous small resistance level here. I want to go and name it. This is the first one, and this is the second one. Here. So from here, the second small resistance level is going to retrace back down here. Okay, this is our neckline, which is our support level. So once it breaks through this support level over here, the neckline, is going to be a bearish run, bearish momentum, unless it doesn't break through this support level. Okay, so this is the confirmation around this area here. So you have to be patient and wait for confirmation, and then it goes all the way up if it doesn't break. So what does a head and shoulders pattern tell you? So after a long bullish trend, the price rises to a peak and subsequently declines to form a peak. The prices rise again to form a second high, substantial above the initial peak, and declines again, as I mentioned earlier. So the price rises a third time. The third time, which is the second shoulder. So as you see here, so the third time here, the third time will be here, but only to the level of the first peak, as I mentioned earlier, before it declines once more. So this is the first rise up, and this is the second rise up. This will be the third rise up. The first rise up and the third rise up will always be the same level, if not the same, but very close level. Let's look at the examples of head and shoulders. Okay, now we can see that this is the left shoulder over here, and this is the head, and this is the right shoulder, right? So for the left shoulder, highest point of the uptrend and the low of the declines remain above the trend line. You can see there's a trend line over here, right? And they are remaining above here. So price goes up, going in ascending order, and retrace back, drop to the support level. This is the support level here. And goes up again in the area of head. The area of head here. This is the highest point. And from the highest point, it's going to retrace or drop back to the same support level. As you can realize that for head, shoulder, left shoulder, head, right shoulder to form, they must have the same level of support level, which is this area here. This area here. So for the support turn resistance, it's common for these same support level to turn into resistance to offer a second chance to sell. So from here, once it break through, this area is going to be bearish. But why it doesn't break through here, it's going to be bullish. So wait for confirmation. And also there's a warning sign that volume of the advance of the left shoulder in normal case is usually higher than during the advance of the head. So normally in this level here, the area here, the left shoulder, the volume is always higher than the head over here. Now we can look at the distance. So as you realize that the distance over here is much longer than the distance over here. But for here, we are waiting for a confirmation that this area is going to form a head and shoulder chart formation. So once it reaches here, then we can have further confirmation that price is going to drop here, and most probably or most likely that the retracement back is going to be the same distance as the previous retracement over this area. Even if it's not almost 100% the same, but it's probably going to be 80 to 90%. So it's going to drop all the way. So let's look at the inverse head and shoulders. So what is head and shoulders? So it's the opposite of what is inverse head and shoulder is the opposite of a head and shoulders chart that is inverse, which also called a head and shoulders bottom. So it's supposed to look like this. Okay, it's supposed to look like this, but in a inverse inverse perspective. So price fall to a throw and then rises. The price falls below the former and then rises again, and the price fall again, but not as far as the first. So this is the first area that we are looking at. This is second. This is the first inverse head and shoulder, and this second, and this will be the inverse head. So it is inverted with the head and shoulder top used to predict. This used to predict reversals in a downtrend. But also this pattern is also identified when the price action of a security meets the following characteristic. The price fall to a bottom to the very low peak, low price, and then rises. The price fall below the former once and then rises again. And the price fall again, but not as far as the first area over here. So once again, when the first inverse shoulder is made, the price heads upwards towards the resistance found near the top of the previous shoulder. So let's see how we can see the direction of our inverse head and shoulder movement. So the price starting from here goes down to the support level and goes up again like a small bounce to the resistance level, and it goes from the top, it goes all the way to the bottom for huge retracement as compared to the previous retracement, and it bounces up again to the same resistance level here, and then it goes a retrace back for a short retracement, and it goes to bounce off again for a small bounce. So you can see this line will be our resistance level for the inverse head and shoulder, and this one will be our support level. So the inverse head is always the one who will be touching the support level over here. So this will be our first support level actually, and this over here, the same level of the two shoulders, will be our second support level. So once price break through here, it's going to bullish, but if the price didn't break through here, it's going to be bearish. So the confirmation is still over this area. So let's look at the examples of inverse head and shoulders. As you can see, the distance here. So price from the top here go all the way down, and we spotted that there's a head and shoulder. And this is the shoulder, left shoulder over here. And from here, from the top, go all the way to the bottom, and from the bottom at this support level here, this is support level, and go up to the top, bounce off for a bit to the top, and from the top it goes all the way back to the head, and the head goes bounce off again, the inverse head bounce off again to the top, and go for a short retracement back to here, and go bounce off again to here. So once it passed through here, once it bounced off and passed through this net line, as you can see, that's the profit area will be here. This is the profit area. Okay, so you take profit around here. So you take profit around here. So you can see the distance from this head of this support level here. This is the support level here, at the level of the very bottom, the lowest to this resistance level, the distance between here and here would be the profit of the distance between here. So this, I will call it area A here, and this is the area B here. So the distance between this area A here is the profit distance for this area B here. So this you can see, like when head and the inverse head and shoulders occur, you will see there's a prior descending trend line before it started to form the inverse head and shoulders. And the left shoulders is always the high of the decline remains below the trend line. So you can see the left one, this is the left one, which is always the highest decline, and followed by the head, and lastly would be the right shoulder. The high of the head breaks the downtrend line. So the left shoulder shown a decline trend line, the decline or the bearish momentum. But whereas when it comes to the right shoulder over here, the right shoulder over here indicates that it's going to break the downtrend line and it's going to be a bullish run. I mean, in usual case. Let's look at the triple top. So what is the let's look at the triple top for the chart. So triple top. Okay, how do you identify a triple top? So you can see that all three peaks are within 3% of each other. And also you can see at first you have to spot like the ascending trend lines. The ascending trend lines will be here. And you can see here is going from the bottom to the top. So there's a 1 times distance from the neckline to the bottom of the head and to the breakout of the neckline. And next you will be identify the distance, the support level for this area here. And the resistance level over here, right? So this will allows you to get the information of the distance between this support and the resistance level. So this one I'll call it as an A. And from this, once this breaks through the support level over here, is going to be a bearish momentum. So you will call it for a short. And the price target over here, B, will be the same as A. So how do you identify? So once this is a ascending trend line and you start to see that it's going to decline from this top and to the bottom, like a sharp decline over here. And once it wait for confirmation, once it break through, then you will be calling for a short over here, right? Okay, this is the same. Okay, now let's do a live chart. We have come to an end of the identify of chart patterns. So any of one want to request for like whichever technical chart that you want to look at, any currency pairs. You can request in the chat box and we'll do a live chat. Any requests for live chat? If no request for live chat, I will just show you any of the live chat then. Gold, all right. You can look at gold. I think I remember I was looking at gold earlier this morning. You can see my screen, right? On the live chart. Okay, you can see that for the past few days, gold has been quite bullish for a moment, and now it's going to now it's like reversing back to the first support level over here. But actually, if you want to play for this gold trade, I think you should wait for a bit, because right now, for this trade, it's like, okay, what where we price for the entry level in the morning was supposed to be like around this area, the first resistance level here. But now it has retraced back quite a lot from the previous analysis. So I would suggest that probably you can wait until it reaches this first support level line over here for a bounce, for probably a short bullish bounce. So let's see like what we have it here. So as you can see that here, there's a overlap. So this one we identify as a overlap, not overlap, sorry, a pullback support over here. This area will be a pullback support. And we have a very, here there's shown a very strong first resistance level, as there's a 2 Fibonacci level. One is the 161.8% Fibonacci extension, and also a 61.8% Fibonacci retracement. So how do we get this first resistance for Fibonacci retracement? It's going from the top over here, this area, to the bottom, all the way to the bottom here. So it retraced for 61.8%, which is here. And for 161.8%, if you can identify, there's a Nike tick, a positive Nike tick over here. So you'll be taking over this from the top over here to the bottom here, and you're going to project for going for Fibonacci extension, which give us this 161.8% extension. So this is considered quite a strong level, whereby there's 2 Fibonacci supporting it. And also for our second support, for our second support will be our stop loss for now. So you will see that there's 50% of Fibonacci retracement over here, that we took it from this level, from the bottom to the top. Here. But right now, if you thought of getting into this trade, it's not recommended, because the profit will be not much, and it's a bit risky that it's going to be bounce off anytime soon at our first support level, which you can see that's is a big pullback support. Do you have any question for this goal? If not, I will go to some requested USD buy. Let's look at it. But this one have gone up quite a lot. I would suggest not to going for this trade yet, because for the past few days and for the past 4 hours, it already went up to quite a high peak. And if you realize, when we are doing on the charting, there's no resistance for the previous resistance level for us to refer or to indicate the resistance level. Yeah, look this. So I think you should stay out of this trade and wait for a bit, because it went up too high. Once trades in this momentum, once it went up too high, or once when it goes down too low, you will have a bounce, right? And right now it has been going up too high, that in a technical way, that or maybe from the manual way, but mostly technical way, that is going to retrace back. So I think for this USD yen, you should wait and see, and wait for some confirmation before getting into this trade. So for now, it's not advised to get into this trade yet. Any charts that you want to see before we end the session? Any chart request? If not, maybe I can show you one last chart before we end it. Let's look at the dollars cat. Okay, never mind. Let's look at the British pound dollar. For pound dollar, okay, let's work on this. Okay. Let me go to mine. Okay, let's look at this. So I will go for, okay, let's look for some trend line if there is. Let's identify if there's any trend line. So for this pound dollar, you can't find any valid trend line. So let's ignore that. Also but there is a valid bearish channel over here. So it means that in a like for now, it's going to be in a bearish momentum. But I will put my price, I will put my entry price over this first support level for bounce for bullish run. Why is that so? Because the bearish reversal is already happened, right? So once you see the price here, it goes all the way up to here and it's going to retrace back, and now it's going to be like bounce off from here. So there will be like probably be a bullish continuation. So once if it's going for a bullish run, and you can get in around this area over here for long, for the price to reach at our second resistance level over here, which is a 61. It's a 61.8%. Yeah, 61.8% Fibonacci. So how do I get that? Is I take it from this area, from the bottom to the top and to the bottom, and project all the way up for Fibonacci projection over here. Okay. Otherwise, if the price break through first support level over this area, this support level is also known as, you can see that previous swing low happened, like previous horizontal swing low happened. As you can see, every time the price goes down to this first support level, it bounce off, and then it goes down again here, and it bounce off again, and it goes down again. So this first support level is a previous level that we can use to refer that where price rise up to a certain resistance level, it will be reversed back and bounce off from this first support level. But otherwise, if it doesn't bounce off from this first support level, it most probably there's another alternative scenario, is that there's a probability of price going to touch on this first resistance level over here, and then it's going to go bearish reverse. Like from here, there's a bearish reverse, or you can say a bearish dip from this first resistance level all the way down to the second support level here. But second support level here is also quite strong level, because you can see there's a 2 Fibonacci level that supported it, which is 127.2% Fibonacci extension. Where do we get that? Okay, let me show you where do we get that for. So for this 127 Fibonacci extension is from this area here. So from the bottom here all the way to the top here, and you go for Fibonacci extension here. So you get this 127.2%. And that's also another strong that I say is aligned quite well with 61.8%. Let me find where's that 61.8%. Okay, 61.8% is going to be a Fibonacci projection. Start from this. It's a huge Fibonacci projection over here. So starting from this point, you go all the way down and up again, and then you project here, you get a 61.8% Fibonacci projection. So this is quite strong second support. So my advice here is don't get into this trade first for pound dollar. Wait for confirmation. Wait for it, either it touches this first resistance level. If it touches this first resistance level, then you go for a short, because a bearish reversal will occur. So you have to wait if it touches this level, or if not, you wait for it to touch this first support level. Once it touch the first if it touch the first support level, and then it will go for a bounce to second resistance. So for this area, it's just waiting for confirmation. All right, do you have any questions? If you have question, you can ask. If not, we'll end this. Let me know. Any questions, guys? Any questions regarding about this trade? No questions. If no questions, then we'll end this webinar off. All right. Okay, since there are no questions, then let's end this off. Oh, thank you, Martha. Thank you for your time. Thank you for your time. Thank you for staying through these webinars. And I will see you guys soon, probably next week. All right, thank you. Thank you, guys. And have a nice day ahead. Thank you. Thank you, Roddy. Okay, thank you, guys. Have a good day ahead. Bye. Thank you, Jenya. Hope to see you guys soon, and play safe with your trade. The market has been quite volatile. Okay, thank you. See you guys. Have a nice day. Cheers.